The model that we will present will highlight how one can possibly develop a fund, thesis, and strategy to set up a private equity fund. This will entail the key building blocks you need to consider in setting up your fund and before approaching potential investors. It will cover practical considerations you need to make in raising a fund, provide the key elements of a compelling fund thesis and its implementation, and finally, we will mention some of the challenges you may face and provide tips on how to manage these challenges.
Welcome to Module 1, Fund Thesis Development and Strategy. This is a module that is presented by Berhani Dempsey and Geeta Dhammaratnam. We start with what is private equity. Private equity is medium to long-term financing, which is provided in return for an equity stake in potentially high-growth private companies. There are several terms associated with the private equity fund that we thought we'd start by just explaining. As you go through the 10 modules, it will help you better understand the way in which these elements come together. The first thing is to talk about the difference between an LP and a GP. A limited partner, an LP, is an institutional investor. They can be development finance institutions, they can be private investors, either individuals or family offices, and they invest in a fund managed by a team. This team is called a GP or a general partner, also known as the fund manager. That's what you are intending to be. Management fee is a fee that is earned by the GP. Typically, this tends to be 2% of the funds that you are managing. There are different kinds of fund structures. Investments can be in closed-ended funds. Often these are 10-year funds. They can be in open-ended funds. This is a little bit less usual. And there are things called permanent capital vehicles, which are completely open-ended. Or what you can do is start on a deal-by-deal basis, where you're investing one deal at a time. When you get to a certain point, what you're able to do is think about how you can convert those individual deals into a fund. Fund management. Private equity funds are structured usually as limited partnerships, and these are managed by the GP, by the fund manager. The capital is used to invest in companies, either for a minority or a majority equity stake, where you're taking less than a 50% stake or more than a 50% stake. You need to also be aware that GPs, fund managers, also invest some of their own money into the funds that they're managing. It is called skin in the game. The lifespan of a fund typically tends to be fixed at 10 years. The assumption is that by the end of the 10 years, you will return the capital to investors, the original capital that was provided to you, plus any additional returns made. The holding period is usually 4 to 7 years. That means how long are you holding the investment? The idea is that after the holding period, you will look to exit your stake or to sell your stake in the company. This could be to another corporate buyer, it could be to another investor, it could also be by listing the company on a stock exchange. When you exit these businesses, what happens is the LPs first receive any returns generated by the fund. It is only when these returns pass a certain point, known as the hurdle rate, that you, the GPs, will share in the excess return with the LPs, and that is called carry. Private equity actually has a long, rich history in Africa. Private equity in Africa was originally pioneered by the development finance institutions. These development finance institutions, DFIs, have a mandate to invest in private sector businesses in developing countries. They aim to do so in order to stimulate economic growth, to create jobs, to develop better business standards, and really to encourage commercial investors to also invest in these developing regions. They continue to perform a really critical role in our industry, and today they remain some of the largest investors in private equity in Africa. There are certain characteristics that they're looking for in successful private equity fund managers. They're looking for a local presence and or networks which are key in generating value. What this means is they're looking for fund managers who are able to show that they have strong relationships in their countries, in their regions, within the business community, and are able to continuously follow up with these relationships to find good businesses and to engage with these companies after the investments have been made. They expect you to know your team and to know your company. Your team come together to really implement a strategy. In doing so, the business that you have is twofold, because your own fund management company also needs to be well run. They are looking for strong investor relations. And that means that there is transparency between yourself as a GP and the investors. They are also looking for good governance practices within your fund management company. They're looking for implementation of best practice ESG standards, environmental, social, and governance standards within the investments that you are making. Essentially, private equity in Africa is a catalyst for change in economies and communities. Really, private equity is becoming better known as a source of value-added financing for growing companies. In this way, it is quite differentiated from debt financing, because private equity investments help companies to grow and in turn benefit the economies and communities in which they operate, while providing financial returns for investors. It really is about having impact as well as bringing returns. There are three practical considerations you should consider. The first is, it can be quite challenging to find the path to exits, which means selling the stakes that you have invested in. One way you handle that is by making sure that you are seeking out those paths to exit from the moment in which you invest in the company. A second practical consideration is that currency tends to fluctuate across many of our economies. You want to be aware of that because it will help guide you towards making one investment over another, or at least to start making some decisions before you even choose which investments to make. A third practical consideration is macroeconomic changes. You will often not be in a position where you're able to do very much about these macroeconomic changes. However, it is imperative that you're aware of what these changes are and how it may affect different sectors that you are focused on, or indeed even your entire business. There are four particular communities that we want to mention to you. The Africa Private Equity and Venture Capital Association exists as the industry body for the entire African private equity space. They tend to have conferences, there's some learning and development that happens with them. You also have the East Africa Venture Capital Association, which does a very similar thing, but focused on private equity players who are in East Africa. You've got PEVCA, the Private Equity and Venture Capital Association of Nigeria, which focuses specifically on providing support and a community for those who are in the private equity and venture capital space in Nigeria. There's a similar organization called SAVCA, the Southern African Venture Capital and Private Equity Association, which really focuses on the Southern African region.
In raising a fund, what are the practical considerations you need to make? The process of raising a fund requires persistence and planning. The technical skills can be collated. However, in order to drive a successful fundraising strategy, the fund partners have to be in full engagement. But in raising a fund, there are key elements that you need to consider. First is the initial capital that is required to set up the fund. The planning and establishment of fund requires engagement with lawyers, accountants, administrators, and maybe some other consultants to help you with the fundraise. So in considering the initial capital required, what do you need to do? You need to create a fund establishment budget early on and consider the sources of financing for the setup, for the cost of the setup of the fund, as this can be significant. Also, be aware of the cost of funding, as it can be translated to equity ownership and carry at a later stage. The second practical consideration you need to make is the timing of the fundraising that it actually takes. On average, it takes about 2 to 4 years to raise a fund. And there are key milestones along the way, but it does take a long time 2 to 4 years. The timing of the launch should also be considered the environment in terms of like which other fund is raising a fund at the same time, the competition, and the like, for example, different holiday periods that are in Europe, US, and within Africa where the LPs are based. So what you have to do is be mentally prepared to go through the time required and focus and plan to achieve the key milestones. This, for example, includes your first close. The third is keeping the lights on. It can, as I said, it takes a while to raise a fund, and you need to make sure that you have sufficient funds to support yourself during this period. That could mean you have to plan maybe to take on part-time work or full-time that you can actually leave once the fund gets traction. But you need to make sure that that you have sufficient support for yourself during this fundraising period. The fourth practical consideration we would say is choosing partners wisely. A fund is usually raised by more than one partners. So you need to make sure that you're partnering with the right partners, that you have maybe worked professionally before or have vetted them personally, and that you're comfortable and comfortable to work with them for the long term. And also this matters for the team members as well. And the other aspect is that you need to make sure that your partners are aligned in terms of interest. Everybody's aligned into the strategy and purpose of the fund. The first task in building your fund is to actually build your fund thesis. And now I'll highlight about 11 elements of building a compelling fund thesis for your fund. The first 5 will focus on the external market elements that you need to think about. And then the next 6 will consider what you need to think about within the organization itself. So the first element that you need to consider in building your fund thesis is to identify the opportunities in which you want to invest in. You'll start by first identifying the geography that you'll be working in, and then the sectors within that geography. And then once you've looked at the sectors, the market depth within that sectors, and then identifying the key players in that target market. Once you've done that, then the next step is to collect data, information, so that you can actually size the market of your investment targets. To do this, you have to make sure it's clearly the opportunities are laid out and articulately and clearly, not only for yourself, but also for potential LPs or investors that will be considering to make an investment in your fund. Once these levels have been identified, then the next step is you need to go and identify what kind of deals are available within those segments that you identified. So you need to determine what kind of companies are within that target sector, what kind of players, and then if you want to do those deals within that sectors. And then the next step is like, once you've identified that, then you have to make sure that what deal is good for you. So the investment rationale has to be clear, and then it has to constitute the key characteristics that you're looking to identify and back. Once you have done your investment rationale, then and identified the opportunities, then you have to look at the growth potential within this target market that you have identified. So you need to demonstrate a deeper knowledge of what you expect will drive the growth of the target market. It can be like on sector, geography, it could be a macro-driven, micro-driven, and maybe understanding the trends and backwards and for, like what's been happening historically and the trends to really understand and demonstrate where the growth of these target opportunities will come for your fund. Other elements, as I mentioned earlier, is really the internal composition and the target returns of the fund and the underlying and the underlying access of the target market. So one of the key things, as I mentioned, is the investment team. The investment team should have experience in working in, for example, the geographies that you've selected, the target sectors, or does the people have investment track record? So the investment team has to have the knowledge and the experience to drive the investment strategy and the investment thesis. Not only the investment team, the fund need to consider other skill sets that's needed within the fund composition, which is, and it could be somebody with administration skills, compliance, environmental, social, and governance skills that are also critical in the composition of the fund manager. Another element that is compelling for a fund thesis is if the team members have had history of working together as an investment team or some kind of working relationship will have a strong element to the fund thesis if this has been the case for the fund that you're trying to set up. The other element is the financial return. Once you've identified the geography, the sector, the team, the costs, and all these, it needs to all go into your model to show that the fund strategy can actually deliver the returns that the investors and yourself will be expecting to achieve. So this will be a model that would be driving your strategy in terms of numbers of all the things that you've laid out in your fund thesis will be reflected in numbers to show that your thesis works financially. And then the other element is also the investors need to understand how you can actually find those deals that you have identified, those target companies that you've identified. Most, if they're not present on the ground, they can use third-party services or have their own on-the-ground networks to identify potential transactions, but also be a very compelling element within your fund strategy if you have, for example, presence on the ground or really strong network on the ground to actually be able to pick the winners of companies within the sectors that you have identified. And then within your strategy as well, you need to show that you know your customers. This means not only the target companies that you'll be looking to invest in, but also the end customers of the businesses. What drives those businesses? Which customers drive those businesses to get the growth that you need? This means understanding your consumer base. Who is your consumer? Is it another business? Is it like a retail consumer? What are their spending patterns? How will you increase the wallet size of these consumers? So understanding even to the end consumer level is critical to verify and support your fund thesis will work and can deliver. Once you have your fund thesis outlined, as shown just now, then implementing the fund thesis, there are key aspects that you need to consider. One is, do you have a competitive advantage to actually be able to deliver on your fund thesis? You need to understand what is your competitive advantage, how's your strength going to support this, and the relationship you have in the market actors. And then within the market competition, you need to recognize there are other funds in the market and really need to demonstrate why companies would prefer to work with you and not the other PE firms potentially. What would bring those transactions to you? You need to demonstrate how you can set up your strategy, execute, attract the target companies, resulting in a strong performance. And also the other consideration you need to make while trying to implement your fund thesis is, usually there's a large pool of companies, but once you have your criteria set out and you narrowed down your target companies and winners within those sectors, this can really shrink quickly. So you probably have started with 100 companies, maybe now you end up with 5. So you need to make sure that there are sufficient flow of transactions and players within that market to be able to make sure that you do have sufficient pipeline or companies that you can consider for investment. And private equity is not just about investing funds and waiting for the returns to come. You really need to think and build within your team how you will add value into those companies. And that's how you create growth, sustainable companies over the period of time, and will make sure your exit opportunities exist. So you need to show how you will help improve, for example, gaps that were identified during your due diligence. How are you going to value add? Are you going to provide training? Are you going to have operational strategy improvements for the companies? Are you going to streamline their operations so that their cost basis is lowered over time and your profit increases? So you really need to think about all the value strategies that you need to implement upfront when you identify a company. This will naturally lead to exit opportunities if the company is doing well, it's grown and sufficient, and all the values are added by you from where you found the company, then the likelihood of finding exit opportunities increases alongside with that. So even though you will need to show how you'll exit or sell your stake in this private business from the beginning, and you need to think about it from the beginning, the value addition will help you to either sell through trade, through corporates or to other investors, or through sell buyback to the owners. So the exit opportunities you need to think from the beginning. But all this also sits on governance. Governance means within the private equity entity itself, how investments are processed, how decisions are made, and how the fund is overall run is as critical as the fund, as the GP itself trying to implement these standards within the companies that they'll be investing in.
There are two elements of your investment strategy that you really want to dig a bit deeper into. The first is the justification for the kind of sectors that you are intending to focus on. The second is the geographic approach. Following are some examples to illustrate what you may want to think through. Healthcare is a sector which is really growing, but is really underrepresented as well within the investment space in Africa and has been for many years. You may think of it as a high growth area, especially in a post-COVID environment when healthcare needs have significantly increased. The UN Economic Commission for Africa estimated pre-COVID that the healthcare financing gap in Africa stood at $66 billion a year. We know that the non-communicable disease burden has significantly increased, and this is quite normal in line with what we've seen elsewhere across the world. These are all elements you may want to weave together as you justify why it is you see an opportunity to include healthcare as a key sector for your fund. You can even go down even deeper. If you look at the entire healthcare value chain, you can look at the financing of healthcare, you can look at the use of technology, you can look at the inclusion of the manufacturing of pharmaceuticals, also the manufacturing of personal protective equipment. So it's not just looking at disease burden and how you're going to be able to invest in businesses which are going to help improve access to healthcare, but it's also looking at that entire value chain. Another example of a sector that you may want to dig deeper into is fintech. So not just stopping at the stage of saying we're investing in financial services, you may want to see how the emergence of fintech, technology-enabled financial services, is going to be something of interest for you and your fund strategy. We know that there is a massive financing gap in terms of inclusion in Africa today for people to access financial services. However, the continent has emerged as a clear leader in terms of the use of technology to address these gaps. You may find that in the region in which you're looking to invest, this is exactly a key demographic that you want to target. Another aspect of this as well is to recognize that often a fintech investment may not require as much capital as investment into a traditional bank or a traditional insurance company. If you look at things from a geographic approach, there's some of you who are going to be looking to raise a fund which is active across multiple countries. So for example, you may want to be raising an East African fund. East Africa was the fastest growing region in 2019, and the average growth rate was 5%. That could be an interesting backdrop. However, when you justify why this region, you really want to go into a lot more detail than that. You want to be able to differentiate what is happening in one country versus a second country, and why you don't want to put all your eggs in one basket by focusing purely on one country, like Kenya. What you might find are elements of the market, which is making it very interesting for you to look across multiple countries. For example, the East African market has over the years become relatively familiar with private equity. There are many family owned businesses in these regions. Therefore, they are more familiar, perhaps, with private equity financing. That may form part of your argument as to why you've chosen East Africa as opposed to another geography. Some of you will consider setting up a single country fund. When you're thinking about a single country fund, you do need to address that single country as if it was a region, which means you need to look beyond the capital city. So you want to explain why, for example, if you are raising a South African fund, why you're going beyond the general macroeconomic indicators. Because whilst it's interesting to note that South Africa's economy is expected to rebound in 2021 at 3.3% growth, that doesn't really show you the reason why investing in Johannesburg and businesses in Johannesburg is fundamentally different to the kind of businesses that you would find in Durban or the kind of businesses that you would find in Cape Town. So you really want to address those differences. So as you're coming up with your fund strategy, what comes across is a very clear understanding of the diversity of the economic landscape in that single country. Having developed your strategy, the next step is to put this down. And what you're going to put this into is what is arguably the most critical document that you're going to have to really gauge investors' interest in your strategy and your ability to execute. What this is called a pitch book. This pitch book is normally developed in PowerPoint. You'd save it as a PDF. You print this out, you'd project it from your computer. It's what you show your investors. Within this, there are several things you want to include. Before I come to what you should include within the pitch book elements, what I want to do is give you some general advice. You want to really use stories of success, personal success, leadership success, success of how you have implemented something within an investment or within a company. Be open about some of the lessons you've learned. Investors like to see that because then they understand that you are also evolving the way in which you do things. Do highlight your team members, bring out your unique voice, and show the investment opportunity that you are targeting. So now is where you want to bring together all that analysis that you've done so far to go beyond the generic overview between the headlines and what is actually happening. There are 11 aspects that most pitch books would have. The first is a fund overview. This is the very first slide of the presentation. So you want to make sure it is really well designed and it is an overview of the entire fund proposition. It is quite normal when you're pitching for you to stay on this slide, sometimes for even a quarter of the time or even half the time, because anything that the investor should know should be on that slide. The next section is really about the fund team. Here, you want to really showcase your team and their expertise. You want to show how it is that they fit together, and you want to show what it is their jobs are going to be, how it is that they are going to work together to execute on the fund thesis. The third element of the pitch book is the investment history of the team. This is what we call the track record. What have you previously done? What have you previously been a part of, especially if you've done this together? The fourth element is strategy. We've spent most of this module actually talking about strategy. Here is where you dive into those details, but do it in a succinct way, which is easy for your investors to understand, knowing that your investors may not know your market as well as you do and may not know your sectors as well as you do. So you want to make sure that they're able to understand what it is that you're doing and what it is you're aiming to accomplish with your strategy. The fifth area is the pipeline. A pipeline is the list of companies that you think you may be able to invest in or you want to invest in. So you want to give your investors or your potential investors an indication of how it is that you're thinking about the investments. And this is the pipeline. The sixth area are the key fund terms. This includes the size of the fund that you're seeking to raise, the compensation terms for the fund manager, the legal structure, where it is the fund might be domiciled, how it is you're intending to structure the return of the fund, and so forth. The seventh area is where you're able to double click down into the market opportunity. And remember, we're not talking about the overall market opportunity. We're talking about a specific market opportunity, which is the market that you are seeing for the types of deals that you are looking to do. And if you're able to bring some clear data analysis around that, then hopefully what the investor should walk away with is two things. One is a clearer understanding of where the opportunity is, and two, they are able to recognize that you are able to see what that opportunity is. Point 8 is the fund size. There are many different ways you can go about trying to size your fund. And at the end of the day, you need to express why you've chosen that particular fund size, that rationale to the investors. It's helpful to put that within the pitch book because your investors will ask that question again and again and again. You might as well be prepared for it. The ninth area is governance. Given that investors, LPs, invest in what's called a blind pool, they don't know exactly where their money is going to end up, not yet anyways. Therefore, they want to be clear that they are checking what the governance is within your organization, within your fund. How is it decisions are going to be made? How is the fund going to be governed? Who is going to be on your board? How is the investment committee going to make decisions and who is on the investment committee? Because in the absence of knowing what investments they are going to finally be backing through their commitments, the next thing that they can check and verify is you. The 10th area is the investment process. Investors particularly care for this because they want to know that there is a consistent mechanism by which you are considering every deal that you are looking to do. And so the investment process can be relatively standard. Some people have a 5-step investment process. Some people have an 8-step investment process. The key thing is that you are clear about what the activities are that you undertake at every stage of the investment process that you are committing your fund is going to follow. The final point to really include within a pitch book is a GP landscape. There are other investors beyond yourselves. And what you want to do is show that you are aware of who these investors are, but you also want to explain where you fit in the competitive GP landscape and how it is you are going to be able to access transactions, find businesses, find entrepreneurs in a way that perhaps your competitors are not.
Even though you may have the best thesis, the best strategy, the best team to implement the strategy you have drawn up, there'll still be challenges during this process of 2 to 4 years of fundraising. So we wanted to highlight some of the basic challenges that you may potentially face and what we would provide as a tip to manage these challenges. First one we'd like to mention is, don't change your strategy for each investor type you meet. You cannot keep changing it, and because every time you change it, then people or investors would think that you don't have a strategy that you don't believe in. So your strategy should be set, and if it's really thought through and planned and has an executing team, it will find investors. But you cannot keep changing it to meet what each investor that you think might want. Second is apply a fresh eye to your fund. There are a lot of private equity funds approaching potential investors throughout the year. So you have to be very thoughtful about the opportunity that you see, really articulate it well in your own words and to show that your approach, your thinking is a unique one and it stands out. As we mentioned during the presentation, it could take anywhere between 2 to 4 years to raise your fund. So you really have to persevere and keep going throughout this period. Early on, you might be getting feedbacks from investors. You continue to enhance your fund thesis, but as time goes along, every investor that you secure is a milestone until you get to your initial minimum fund size that you want to work with. So perseverance, focus, and planning is very, very key throughout this period. Sometimes you would have a very good strategy presented to a potential investor. That investor would say no. to come into the fund. But this does not mean that your strategy is not right, you need to change it, you need to adapt, but it could only mean that what you're trying to achieve does not fit into the potential investor's own strategy. So you can learn from it even if it doesn't fit. It will be a part of your learning process. But again, as the first point that we made, it doesn't mean that you have to keep changing to attract every type of investor that is out there. So key message is believe in the strategy that you have, the implementation capacity that you believe you have, and in your team, persevere, keep going, and you will get there, and you'll have the fund that you have sort of setting up in the first place.